Hello friends, today we are going to see one small topic but very important topic from your practical perspective. Okay, so most of the times I have seen students who are studying for CA final or students who are preparing financial statements during their articleship getting confused between three terms: cash, then you have cash equivalence, then the third bank balance. Okay, so the terms cash and bank balance is something which we all know, which we all are very familiar. Cash means we know what is the what do you mean by cash in colloquial terms, as well as bank balance, what do you mean by bank balance, that also we know. But when it comes to schedule 3, especially in the case of a company who prepares the financial statements in accordance with schedule 3, whether it is Ind AS or the normal accounting standard, okay, you have to give these three categorization in its balance sheet. So I have seen students who commits mistakes in classifying the items correctly over here. So today that is what we are going to see. Okay, so what do you mean by cash? What is cash? So when you talk about cash, is it the currency in hand alone? Most of the people think, or most of the students think, when we talk about cash for the purpose of schedule 3, it is just the cash or the currency on hand. No. Currency on hand, of course, it is nothing but cash. So cash includes currency on hand. Currency on hand. In addition to this, you have one more item which will come under the categorization of cash for the purpose of your balance sheet or schedule 3. What is that? That is nothing but demand deposit in bank. Demand deposits in bank. What do you mean by demand deposits in bank? Demand deposits in bank means the moment you demand the money from the bank, they are bound to give you. You can withdraw this amount at any time. So any amount you keep in the bank which will entitle you to get it or withdraw that at any time is also classified as what? Cash. And if you ask me examples, the best example is the money which you are holding in your current account. Okay, so example, amount held in current account. Okay, so it is only the demand deposits, the fixed deposits or term deposits. Is it covered in cash? No. So only the current account balances have to be categorized as what? Cash. So be very careful. This is very essential when you prepare your cash flow statement also. Okay. Now, so having seen what is this cash, now you have to see what do you mean by cash equivalence. Okay, cash equivalence. So definitely there is a difference between cash and cash equivalence. It is not one and the same. There is a difference. So as per Ind AS 7, in order to call or in order to qualify to be a cash equivalent, the items have to mainly satisfy three conditions. Okay, so cash equivalents are short term, highly liquid. Short term plus highly liquid. Liquid what? Liquid investments. Liquid investments. So these are short term and highly liquid investments, which means three criteria. One, what is the first criteria? Readily convertible into known amount of cash. So the first one is readily convertible into known amount of cash. So you have to keep this in mind. So it has to be readily convertible. There could not be any delay. Okay, and also when you convert, it shouldn't be like at the time of conversion they will decide how much to give it. No, it should be readily convertible into known amount of cash. That is also will be classified as what? Cash equivalence. So this is only one criteria. Now what is the second criteria? Okay, the second criteria is, okay, subject to insignificant risk of change in value. So these are items which are subject to insignificant risk in change in value. Risk of change in value. Okay, so there could be change in value, but the risk of that change in value is very insignificant, because you know, even if it is converted into, you know, cash, how much is what you are going to get, that you know beforehand. Typical example, your deposits with the bank. If you are holding a deposit with your bank, you know when you convert that into cash, okay, how much money you will receive. And do you think that there is going to be any uncertainty with respect to the amount that you will realize? No. So that is second criteria. Now, what is the third criteria? The third criteria is also very important. The maturity should be less than 3 months from the date of acquisition. So, maturity less than, it's not greater than, maturity less than 3 months. And I have seen students taking this 3 months period from the date of balance sheet. Is it so? No. This 3 months have to be considered from the date of its acquisition. 3 months from the date of acquisition of the investment. Okay, so typically any fixed deposit you are keeping with the bank will qualify to be a cash equivalent, provided its maturity, original maturity, is less than 3 months. Because any fixed deposit, it will be readily convertible into non amount of cash. It is subject to insignificant risk of change in value. Now, its maturity is the only concern. If the maturity is less than 3 months, classify it as cash equivalents. If it is more than 3 months, what you cannot classify it as cash equivalents. Okay, so this is cash equivalents. Now, if I give you some examples on this, let's say fixed deposits, it's fixed deposits up to 90 days. It will be what? Cash equivalents. But any fixed deposits with the bank where the maturity is more than 90 days, then it will not be considered as a cash equivalent. Okay, similarly, okay, there could be other investments like treasury bills. Okay, you would have heard about T-bills or treasury bills. Okay, any treasury bill, T-bill is nothing but it is the investments or the instruments which are issued by the treasury, central government or state government treasuries. So it is government deposits or government bonds. Okay, and if the T-bills or treasury bills has got a maturity less than 90 days, less than or equal to 90 days, then what happens? This is cash equivalent. But if the maturity is more than 90 days, then it is not a cash equivalent. Okay, now there could be some confusions here. Okay, what if it is a mutual fund, investment in mutual fund? Is it going to be a cash equivalent? No. Irrespective of whether its maturity is even if it is 1 day maturity, it is not going to be a cash equivalent, because what? It is subject to the risk of change in value. Any mutual fund is subject to risk of change in value, so it cannot be classified as what? Cash equivalent, even if the maturity is just 1 day. I hope that is very clear to you. Okay, right. So now I will have to come to the next point. What do you mean by bank balance? Bank balance. Typically, this bank balance is not something which is defined in the Companies Act or Schedule 3, okay, or even in the Ind AS. So bank balance means any balance in the bank, okay, other than two things. What are these other than two things? One, cash. Two, cash equivalent. So if you have any balance in the bank, either it has to be either classified as cash or cash equivalent, or if not, it has to go as bank balance. So bank balance means it is the residual category. I hope that is clear. Okay. So typically any any deposits, term deposits with original maturity, above 3 months will be taken to be bank balance. So when you prepare the financial statements, especially in according schedule 3, you have to give this classification very clearly. So if you see the phase of balance sheet, you have what? It will be cash and cash equivalents. This is the name that is given in the schedule 3. But if your bank balance includes other bank balances other than cash equivalents, then on the face of the balance sheet, instead of cash and cash equivalents, we have to disclose it as cash and bank balances. And what do you have to do? In the schedule, you have to first give cash and cash equivalents. In that first one will be cash at hand. Okay, then cash at bank. This is demand deposits. Then next, cash equivalents. Okay, this is cash and cash equivalents. Now the next category will be in the schedule will be other bank balances. Other bank balances. I guess this is clear to everyone. Okay, so this is how you have to disclose this cash and bank balances in the financial statements. So if you have any deposit, fixed deposit or term deposits with maturity above 90 days, then you should not give cash and cash equivalents on the face of the balance sheet. Instead of that, you have to give cash and bank balances, and in the schedule you have to give this disclosure. I hope that is clear. Okay, now if you come to bank overdraft, this is also one area where students get confused. Bank overdraft, you know what is bank overdraft? Bank overdraft is kind of a borrowing that you get from the bank, but it is not like any term loan or any education loan or any other term loans which you take for a particular period and you are required to repay only over the period. Okay, it is not like that. Bank overdraft is some facility given by the bank to overdraw the amount which is not there in your bank. Suppose your bank has a deposit of, let's say, 100,000, 1 lakh rupees. If you are given by a facility by the bank to overdraw your account by 5 lakhs, then how much can you withdraw from the bank account? You have 1 lakh over there, plus you can overdraw by 5 lakh, which means you can, right now you can draw how much? 6 lakhs. So that facility which entitles you to overdraw from your bank account the money which is not there in your bank account, or over and above the money what you have in bank account, is what is known as overdraft. Now, can you consider this overdraft as part of your cash and cash equivalents? The answer is very, sometimes you can, sometimes you can't. Now, as per Ind AS 7, okay, if you want to classify a bank overdraft as a cash equivalent, okay, under cash and cash equivalents, okay, you have to see whether this is an integral part of cash management. What is this integral part of cash management? See, most of these business entities, what they do, they just take one bank overdraft and they keep it with them. They use it only when there is a temporary crisis. They are expected to get some cash or some check. It took some delay in clearing or realizing the check. So what they did, For meeting that gap, they went to they utilized the bank OD. Now the moment the check comes back, they are going to repay the bank OD. If this is the pattern what they follow, it is known as integral part of cash management. So if the bank overdraft is used only when there is a shortage of fund, only for a limited period, then you can say that it is an integral part of cash management. Otherwise, if you are saying that, okay, I have a facility of 100 lakhs or 1 crore, all throughout the year, my bank OD will be overdrawn by 100 lakhs or maybe by 80 lakhs. Or I will be utilizing this throughout the year. If that is the case, you can't say that it is a part of my cash management, rather it is like a loan facility. Okay, so if bank OD, if it is an integral part of cash management, the answer is yes, and here no. If it is an integral part of cash management, then what you have to do, it has to be considered as cash equivalent. So effectively you will reduce it from the cash equivalent. But if it is not an integral part of cash management, it will be taken as borrowing. You can't classify it under this one. So this is the typical difference between the bank overdraft. And if you regularly use overdraft for working capital, okay, then it has to be considered as what? Cash credit, cash equivalents. Whereas if it is a loan facility, then you have to take and you have availed it and you are not going to repay it in the near term. Okay, if that is the case, it will be classified as borrowing. So you will have to see what is the purpose of getting this overdraft. Is it to fund your your long-term projects in the form of working capital or whatever? Then it is a loan. Otherwise, it is a cash equivalent. Friends, I hope that is very clear to you. This is even though this is a very small topic or simple topic, I know most of you will be having confusions over there on this topic, and I hope this session has helped you to clear your doubts on the classification of cash equivalents and bank overdraft. Thank you.